you confused about interest rates when it comes to financing? How about cost of capital, or factor rate, or debt service, or what decisions should I make on my financing options anyways? Well, my name is Scott Peper. I'm the CEO and co-founder of Mobilization Funding. Today, I want to talk to you about how to make those decisions, what each of those terms means, and what you can do to make the best choice for your business depending on what you're looking for. First, what is APR? Personally, I hate acronyms, so APR is annual percentage rate. Some will say per annum. Who knows? They come up with all different terms, but per annum, ANNUM, or APR, or annual percentage rate, all mean the same thing. All that is what is the percentage you are being charged of the debt that you are incurring, and it's typically charged against the principal balance. But of course, there's a catch. Sometimes you'll get a loan that might have a principal balance of $1 million, but you only have access to $300,000 or $400,000 of it, but yet you're paying interest on the entire $1 million. So is your real cost of capital the percentage rate of the principal? Not really. Sometimes you'll get the entire $1 million up front, deposited right in your account. You'll have total freedom to do whatever you want with it. In that particular case, the annual percentage rate is probably more accurate to your cost of capital. Let's look at a mortgage, for example. When you get a mortgage on your personal home, you have an annual percentage rate. Well, we all know you don't pay interest only on those mortgages, and they're amortized. So your actual cash outlay has some form of principal payment and some form of interest payment. But we also know that the earlier in the loan, of that number you pay every month, much more of it goes to interest than actually goes to principal. So even though your annual percentage rate is a certain number, your actual cost of capital for year one on a 30-year mortgage is a lot different than it is on year 30. Okay. So that's APR, or annual percentage rate. The next is a factor rate, or let's just take an interest rate in general. Depending on the type of loan, interest rate is just the actual rate you are being charged for the specific amount of time or the payment amount. So if you're doing a line of credit, for example, and you're paying interest only, then your true cost of capital will be the amount paid for that specific period of time. So easy math. Let's say you have $100,000 in a loan, and it's a line of credit with a bank, and your bank charges you 12%, which otherwise would be 1% a month. Your cost of capital, or your percentage paid, would be 1% or $1,000. Now let's talk about factor rate. A factor rate can be used sometimes as a percentage, a fixed percentage amount that is going to be charged against an invoice. So for example, if you're factoring invoices, that's a form of debt and financing. Actually, it's not a form of debt, I'm sorry. It's a form of financing, and that's where you pay a percentage or a factor rate against your invoice. Let's use easy math again. A $100,000 invoice that has a 2% fee attached to it, or a factor rate, you're going to pay $2,000 for that specific invoice for that period of time, which is typically 30 days. It's also very important to know that factor rate or charged interest, and some are different, you got to look at the terms, all depends on the time frame. So that all builds up for you to have to determine what is your true cost of capital. And you hear me keep using that word, cost of capital? That's coming up next. I'm going to tell you what that actually is. And fourth is cost of capital. What that actually is the total cost of the money. That's the most simplest answer. Your cost of capital, capital being the cash you get, in terms of the loan amount or proceeds received, against the amount you're actually paying for that, the amount of cash it costs you to pay for that over a certain period of time, is your cost of capital. Your percentage, as it relates to a cost of capital, is also significant. For example, if you receive $100,000 today and your cost is 12% interest rate, an annual interest rate of 12%, but you only use the $100,000 for 2 months, then your cost of capital would be $1,000 per month, or $2,000. So your total cost of capital, the total cost to use the $100,000, cost you $2,000. All right. Now that we understand those terms, and again, we can get in, I could almost do a whole presentation on all of them, but I want to get to the point. The point is, how do I make better decisions when I'm trying to decide what type of financing I get? And at the end of the day, as confusing as those 4 examples are, and if you grasped even half of what I explained, great. But what's more important is what I'm going to talk about next. And that is, how do I choose what type of financing based on what I need to do? Next, helping you make decisions on this. Now that we understand what each of those are, what I want you to do now is figure out what and how you're going to make the decisions you're going to make for your financing. And there's a couple key criteria that you need to understand. The first, what is the use of the cash that you're looking for? Are you buying equipment? Do you need it for general operations? Are you late on your rent by 6 months? Did your accountant mess up and give you a tax bill you didn't expect? Did you need to purchase material up front? Do you want to purchase material up front? Do you need to make payroll taxes? What is the use of funds? There's tons of them, and none of them are bad uses of funds. They just happen to be what you need them for. But based on what you actually need the funds for, it's critical to try to make the right financing decision for those use of funds. The second is, what time period do you anticipate A, needing those funds, and B, your ability to pay them back? That's a critical. So far we have, what are you going to use the funds you're looking for, and what's the time frame you have to use them, but more importantly, to also pay them back. And then the third piece is, what is the purpose? Okay, what is the purpose of what you're trying to accomplish? Okay, and if it's just one specific thing versus growing your business, those are two different things. Growing your business is going to have factors that probably include all of those. But what I want to discuss now is, how do you decide on how you use those determining factors to make your decision? You see, if you look and analyze just what is your annual percentage rate or what is your interest rate, I think based on the explanations I gave you up front on what all those different costs are, you can quickly see how confusing it is. And in that confusion is where you can make some dramatically bad decisions. For example, if you take out a loan for $100,000, I'm just going to use round numbers to make this easy. If you take out a loan for $100,000 and it's a line of credit that you can use over and over and over again, you might borrow $100,000 a month but pay it back every month. In that particular case, you would have had access to $1.2 million that year, or $100,000 a month times 12 months, $1.2 million. Well, to get access to $1.2 million, how much did that cost you? Well, if your annual percentage rate is 12% and you never had more than an outstanding balance of $100,000, then the $100,000 cost you $12,000 that year. But you also got access to $1.2 million. That's the difference between a line of credit and a regular term loan for $100,000. Speaking of term loan, if you borrowed the same $100,000 at a 12% interest rate and you got the $100,000 up front, but then you had to make payments, principal and interest payments, over a 12-month period, or 52 weeks, for example, if it was weekly payments, then that same cost of capital, $12,000, also didn't give you the same access to the amount of cash flow you had. You only had $100,000 instead of $1.2 million. You had to pay $12,000 to use $100,000 instead of $12,000 to use $1.2 million. And you were condensed with what your uses of those cash could be over the period of time for which you were going to spend the first $100,000 and not utilize $100,000 multiple times throughout the year. Next, what if you want to grow your business? Okay, well, you might analyze your business, say, I'm going to do $40 or $50 million worth of work this year. You might have done $5 million last year. You may say to yourself, okay, well, I have $5 million this year. I think I can grow to $10 million. Well, you build a plan and you say, in order to do $10 million, my cost of materials are X, my cost of labor is Y. I need $3 million, a $3 million loan in order to grow from $5 million to $10 million. So you go on the hunt for a $3 million loan. The problem is there's so many factors inside that decision for you to get a loan to get you from point A to point B, 5 million to 10 million in this particular example, that it's just too hard to kind of calculate. The other things are what covenants and what requirements are going to be put on your business for borrowing $3 million. And maybe it's only $1 million that it really is hard to determine because you don't know when that $5 million is going to come in uses of cash. The things you want to try to decide is, it's very confusing in this scenario. What's critical and what I want you to take away from this video is, it's way more than just the interest rate. It's way more than what is the cost or the percentage. Just like we talk about going after new work. You need to talk about performance when you're going after new work, not your price. If you talk about price and being the cheapest, then you're going to win and lose on price, and you're not going to be able to perform your best. Well, getting financing is the same way. If you only focus on price, you're going to miss the other 15 different factors that you need to decide upon in order to that are critical for your business, for your uses of that cash, for the time period you're going to use it in, that is equally as important, if not more important, than the price. Because I might be an advocate to tell you to pay more of an interest rate, but have all the other factors in perfect alignment for you, and you're going to be far better off. Cheapest cost of capital, but yet it hamstrings you or only helps you halfway. Last time I checked, when you need help with something, someone that only helps you halfway means you have a requirement for the other half. You need to find something else for the other half. In the debt world, financing world, the last thing you want is only half the money you need access to. So in follow-up, and so in conclusion here, I purposefully explained all those definitions to you fast and upfront because it's confusing. And I wanted you to hear how confusing it can be. After I heard them, I said to myself, so what? Okay, what does all that mean? Well, that brings me to the next point. What's critical about this information is that you need to know what your uses of cash are, purpose and intent that you want to use it for, the time frame, and what your hope and goal and outcome is at the time you have the cash and use the cash. Once you can answer those questions for yourself, then find a trusted advocate and explain exactly that. Because in this financing world, there's so many different forms of cash or capital that you can utilize. And what's critical is making sure you find someone to help you navigate that world. Remember, if you're working with a broker or a consultant or your banker, make sure they have access to multiple different financing criteria. Make sure they understand all of them, because that's what's important and critical for them. But more importantly, you have to be able to tell them what you're using it for, what your intentions are, and what your hopeful outcome is. And stay away from focusing just on price until you answer those questions for yourself. Because then, once you lock in the right product for you or the right type of financing for you, then obviously you want to hone in on the price and find not only the best price, interest rate, factor rate, whatever it is. You want the best cost of capital for you, but equally, or even more important, you want that capital to work for you in the manner in which that you need it to. Getting the money when you need it, paying it back when you need it, and making sure it works with your cash flow. I hope this video helps you all. If it did, please take a minute and subscribe, tell your friends, and let us know how else we can help. God bless you.